Peg Keogh here from College Aid Pro. Today, I want to talk about federal direct student loans. What are these? How do you get them? Are they a good loan to take out? How much can you get? All that fun stuff. So basically, if you submit the FAFSA, the free application for federal student aid, which is required by almost every school in the country to receive financial aid, you are eligible as a student. That's all you need to do. These are loans given out by the federal government. The government's encouraging kids to pursue post-secondary education, right? They're trying to soften the blow and give a little money to kids to support furthering their education. So you submit the FAFSA and you're automatically eligible. This is how it works. There's a maximum of $27,000 that each student can receive over 4 years of school. Now, I will say there's a few exceptions where a student may be able to receive more than that. But I'm going to talk about the lion's share of kids. Lion's share of kids are going to be eligible for $27,000 over 4 years of school. And that breaks down into $5,500 for freshman year, $6,500 for sophomore year, and then $7,500 for both junior and senior year. So if you add those up, you get $27,000. Those are the maximums. The thing to realize about this loan is it's use it or lose it. So what I mean by that is if you don't take the loan freshman year, you can't go back sophomore or junior year and say, oh, we used up all of our 529 or our funds are gone. I want to go back and get that loan. You cannot do that. So you want to make sure you lay out your 4-year plan. And if you don't accept these loans in a given year, you're doing it very intentionally, knowing that you don't need them. So that's the first thing that I want to explain, because I've worked with families and it's happened and it's a shame. So the other thing is there are two types of federal direct student loans. There's a subsidized version and there's an unsubsidized version. So in the subsidized version, basically the government is paying the interest on that loan until 6 months after the student graduates. Now, the family needs to have need-based aid eligibility. They need to have the need in order for the college to award that student a subsidized student loan. If the family has no need, then the college will award what's called an unsubsidized student loan. And this is the same loan, same interest rate, but the interest starts accruing when the loan is realized, just like any other loan, right? So you don't have that perk that the government is covering the interest on it until 6 months after the student graduates. There's maximums for subsidized student loans every year as well. So freshman year, the most subsidized loan you can receive is $3,500. Then sophomore year, it's $4,500. And then junior and senior year, it's $5,500 each year. So basically, if the family has enough need, a college could award a student $19,000 of subsidized direct federal loans over 4 years, and then an additional $8,000 of unsubsidized loans over those 4 years. So just think about it. Every student can always get $2,000 of unsubsidized loans on top of whatever they get for subsidized. So Bill Gates's kids, obviously there's no need-based eligibility. Bill Gates's kids could be awarded freshman year $5,500 of an unsubsidized student loan because it's not based on need. And for his family, it would be $27,000 over the 4 years of completely unsubsidized student loans. These loans have a fixed interest rate per year. It's based on the 10-year Treasury note. So when that goes to auction every May, then the government resets the interest rate. So that's another positive of this loan because it's fixed. A lot of other private student loans have what's called a variable interest rate. So if interest rates are going up, then your interest rate could change as you're paying off that loan, and the payments are going to get bigger. But with the federal loans, it's fixed for that year. So each year, you're going to be accepting the student loans at whatever interest rate they're offered at, if you choose to accept them. You also can choose to accept the subsidized version, but not the unsubsidized that's awarded. You can do that as well, and you don't have to take the whole amount. But like I said earlier, if you're not going to take these loans, you need to make sure you don't need them over your 4-year plan to pay for college, because you can't go back and get them. So for most families, this is the best place to start. If loans are going to be part of your funding strategy, which it is for a lot of families, this is the best place to start. I won't say that across the board because every family is a little bit different, but usually this is going to be the best interest rate. You've got a fixed rate. There's a lot of positives here. You'll be able to consolidate if that makes sense when you're done. There are some loan forgiveness programs depending on the occupation that the student goes into when they graduate. So there's different pieces like that that you're not going to typically find in a private student loan. So there is a lot of confusion around this. So I hope my explanation cleared up some of the confusion. And when you get to that point in the process where you're looking at loans, you'll understand what that piece means. The last thing I want to share is once the student accepts these loans, there is a requirement to go through a one-time loan counseling online session where there's a quiz, you answer some questions, then the student will e-sign the promissory note and they're good to go. The last thing I want to mention, and this is a big positive of taking out these loans, is this loan is exclusively under the student Social Security number. It is their debt, mom and dad, guardians, nobody else is on the hook for repayment of this. So basically, the student is starting to build a credit history, which is a huge positive because when kids graduate from college, they want to move in with a bunch of their buddies and sign a lease and they have a job. If they have no credit history, they might be coming back to mom and dad to co-sign a lease. So it's a very good idea to get your kids to start building a credit history, because when they start that next chapter and they're truly, hopefully, basically providing for themselves and paying all their bills post-college, that they'll be able to sign leases and move forward with that, because when they check their credit, they'll have a credit history. And if they're paying things on time, they'll have a positive credit history. So that's all good to start that next chapter of their adult life. So now everything should be cleared up about federal direct student loans. And as always, happy planning.